Good day. It's Tuesday, May the 9th, 2023. I'm Martin Gago with Market Radius Research, and we've got CEO Dave Harper of Geodrill joining us. Geodrill just released their Q1 2023 financial results, which saw record Q1 revenues, and we're here to dig into those results and the business with Dave. But please remember, this is neither a recommendation nor investment advice. We're here to learn about the news and the company. Dave, thanks a lot for joining us. And why don't you please give us a few highlights out of the quarter?
Great to be back with you, Martin. Thanks very much for having us again. Well, Geodrill just today announced our first quarter results for 2023. The results were outstanding. We delivered a record quarterly net income, a record. And this came out of our second highest ever quarter one revenue result. And it was actually our second highest ever quarterly result and our best ever quarter one result. It was the result of a proven strategy of delivering, high quality drilling services that attract long-term contracts and provide us with recurring revenues and cash flow visibility.
All right. One of the numbers that stuck out on the quarter for me was the strong revenue. And this is seasonally is a good quarter, but not your strongest quarter. I guess typically Q2 is the strongest, but your gross margin went up to 32%. I believe last year it was 29%. What's driving that increase in gross margin?
So we were particularly encouraged by this. It's really been a strategy to become less aggressive on winning every job as the industry utilization continues to increase globally, and we approach that international inflection point where we start to see pricing leverage. We're starting to see a bit of that. So it was about improved efficiencies. It was about some pricing leverage. It was a combination of the two, really. And this is where we believe we need to be heading. If you look back, we've had a pretty good run the last couple of years. Coming out of COVID, we had a 40% year-over-year improvement in going from 2021 and 2020. Last year, we had a 20% year-over-year improvement. This year, strategically, we're not going for that aggressive top line growth. We're actually quite content to, go about things in a more qualitative way, such that we're not aggressively out there bidding every job and trying to take all the market share. We're happy to, let our competitors have some of that, and I think this will have a positive effect on pricing leverage. The first green shoots of which we've just seen. As you correctly pointed out, our Greek GP improved year over year. We've gone from 29 to 32%, which we find encouraging.
All right. So just to clarify on that, you're not chasing after every business. You'd rather get good quality, high margin business than volume at the expense of kind of lower margin business. That's the kind of overall strategy.
Well, costs increase for the right reasons. First of all, we're operating in an environment where our costs have increased, and we need to capture some of those costs. We're also operating in an even playing field, so our competitors are seeing the same cost increases. We're able to manage those cost increases a little better because we operate more efficiently. We have the infrastructure that our competitors do not. But if we just look at the industry as a whole, and we look at the cyclical nature of this business, drilling prices from where we were in the peak of the last trough have come down as we bottomed out a couple of years ago. Drilling prices declined globally by about 25%. Now, I think the industry's done a reasonable job of clawing some of that back, but this has also been in an environment of rising costs as well. For our part, as more of the fleet is becoming more utilized, we'll become less aggressive towards adding capacity to meet that demand, we'll be happy to see our utilisation increase and our competitors' utilisation increase. And as a result of that, I think it'll be overall, I think it'll be good for the industry.
On your earnings call earlier today, you talked about how it looks like on the industry on a whole globally is sort of breaking that 50% utilization rate threshold, and that typically triggers some pricing leverage on the vendors. You're able to put a little more pricing power into the market.
That seems to be the historical inflection point. Yeah, I'm in the industry 30 plus years, 35 years, I think, and every 5 or 6 years, the industry goes from peak to trough, and in the trough, our pricing tends to go down, and it goes down with declining utilization of global drilling rigs. As more rigs get parked up, prices go down. It gets more competitive as those rigs become deployed. And the global international utilization reaches 50%. That's where historically the pendulum swings in the direction of the driller, and pricing seems to be generally more accepted. Whereas when the utilization is low, well, obviously there's a lot more pushback because there's more competition. There's more people out there keener to keep their drillers out there keener to keep their rigs busy. And so just to put that 50% number into perspective, the industry has been as low as about 25% utilization a few years ago. Now that's been increasing steadily, and we've just, I believe, passed the 50% threshold. So we're past that inflection point where we would historically see pricing swings in the favour of the suppliers, in this case, the drillers. Yeah.
And just to be clear, that's industry-wide utilization rates. Your utilization rates are more at around 75% or in that range, isn't it?
That is correct. Yeah, for the Q1, we were at 70%. Through most of last year, we're at 70%. We always seem to be at about 70%. We've been there for the last few years. Whenever our fleet reaches 70% utilization, it signals us that it's time to start adding rigs, or else we're going to disappoint our customers. We don't want to do that. We don't want to lose market share to our competitors by not being able to service our customers. So we take the cash, which is generated from operations, and we immediately allocate that to new equipment, new drilling rigs. So this has been the cycle of Geodrill actually since inception. If you know the history of the company, we began 25 years ago with 1 rig and 1 contract and 100% debt. So there's a lot of ones in there. And 25 years on, here we are, we're approaching 100 drills. We're actually approaching 80 rigs now, but we're inexorably moving in the direction of 100 rigs. We'll probably get there in the next few years at this point in time. And every time we add a rig, which is done through the cash which is generated from the operations. Sometimes we finagle with, bank debt to help us, if we, to finance these things. But for the most part, we finance them out of cash generated from operations. The best use of that cash is to allocate it into rigs. For every rig that we allocate, new rig that we add to the fleet, we increase our revenue by $2 to $2.5 million a year. And on that $2 to $2.5 million a year, we generate 30% GP margins. So the payback's quick, and it's the best use of, the return on capital is great.
Okay, that's an interesting metric. So kind of 2.5 million, and we're talking. All your financials are in US dollars. So everything we're talking here is USD, right?
Correct. I mean, if you look at our fleet, correct, yes. If you look at our fleet today, we've got 5 rigs. We generated $115 million in revenues. So divide that number into one to the other, and not all of the fleet is utilised. So you can say that for every, and the rigs don't always arrive on the 1st of January and give us a full year's production. But in general speaking, if you divide our rig count into our total revenue, you'll come out with a number somewhere between $2 to $2.5 million a year. So it makes sense basically to take our cash, put it to work by adding rigs, just 100% organic growth. This has been a 100% organic growth story since inception.
I'm curious, when you say that pricing dropped during the trough of the cycle and things are increasing now by 25%, just the base, is it, when you measure that, is that like on a dollars per meter drilled, or is there sort of a generic sort of rough thumbnail metric that you kind of compare things on?
No, drillers are paid by the meter.
Yeah. Okay.
And the meter rates that we're paid per meter typically from the peak to the trough is about a 25% spread.
Okay.
So if prices come down 25%, drillers, most drillers are losing money but they're happy to keep their rigs, because it's really, what costs a lot of money is when rigs are not actually drilling at all.
Yeah.
So I think most of the bigger drillers are happy in a down cycle to keep their rigs working, because it's a case, at least in their case, it's a case of losing less money. What this company has been able to do quite successfully, I believe, is navigate its way through the cycle such that we're profitable through the down cycles, and more so during the up cycles. If you look at the last 25, well, if you look at this last down cycle, which began, the last peak, it was say 2012. Through 2013, 2014, they were difficult years for us. But we were still EBITDA positive, where most of our competitors were not. When we reached about 2016, we became cash flow positive, and we started to take the cash generated from operations and from the spare cash that we had. We were investing it and doing some pretty good deals, just expanding the rig fleet slowly with cash that was coming in. It was actually a massive growth period for us. We went from 35 rigs. I think we almost doubled the rig fleet just in time for the beginning of the onset of an upcycle, which began in earnest about 2 years ago, 18 months ago to 2 years ago. We've now actually been in. It doesn't feel like it, when you look at our share price. But if you know anything about the industry and these numbers, you'll be able to work out that we've actually been in an upcycle for the best part of probably 2 years.
Yeah.
And if we look at how long this is, the interesting question, the other flips on the flip side of that is, how long is this cycle going to last? Well, I guess if you look at the last down cycle, it was 7 years in the making from the peak to the trough. Now, cycles tend to be parabolic and northward tilt, on a northward axis, and that's why things, the lows keep getting higher, and over the course of history, things just generally keep moving in the right direction. So if we look at it as being a 7-year down cycle, and we're 2 years in there, I think we can say with some confidence that we have probably got 5 or 6 years left to run in the cycle.
Yeah, and that's giving historical norms, but at the same time, we've got this whole electrification of the economy, and the huge deficits in a lot of key resources like copper and other things. So anyways, there's a good bullish case for that.
Well, that's actually the elephant in the room. This is the first time in my 35 years in the industry I have seen the first time where everything is being drilled for. We're drilling for like normally you might be drilling for gold and they say nickel. At the moment, we're drilling for gold, nickel, base metals. We're drilling for EV metals, lithium, scandium, rare earths, everything that basically goes into an EV. If you look at the amount of copper, just copper alone, that goes into one of, what all this electrification that's going on, it's massive. This is the greatest transformation since the Industrial Revolution. We've taken all those gasoline guzzling cars out there and saying we want to convert them to electric vehicles. And how is that going to happen? Where's all the copper going to come from? This will require 3 times the amount of copper we've been mining historically for the last however many years. And so where's all that going to come from? It's all got to be drilled. These mines don't find themselves. They've got to be explored. They've got to be drilled. And then, of course, you've got gold. There's big things going on in gold at the moment. If you look at the central bank purchases, the net purchasing in the last 2 quarters, it's up 3x, 300%. It's insane. And, as I say, it doesn't really feel like an upcycle yet. There seems to be a bigger story out there that's playing out. And I'm just wondering when it's going to kick in, because, you know, you can't have a 300% increase in central bank gold purchasing in 2 consecutive quarters without that affecting the gold price. I think gold's going to, you know, I believe there's a big story that's building for gold. And there's all this, you know, central bank digital coin movement. You know, there's already anyway, I'm not a banker, we're just drillers. You know, when the phone rings and somebody says they want to drill, we drill and we say, yes, we can. But what is very interesting, what's sort of playing out at the moment is I think this is probably going to end up in a super cycle. Yeah.
Yeah. Well, and I don't want to get caught up in gold, but considering gold's at $2,000, the gold market seems very lackluster, or the equities and so forth. It's like 10 years ago, people were killing for $2,000 gold. Anyways, I do want to get on to your
deep value there. I mean, for value investors, they need to look no further. They don't need to be looking at Tesla at 50 times price book. You know, price earnings or whatever it is. You know, the deepest value out there, the most profitable companies out there are the miners and frankly the picks and shovels. Some of the starting with the drillers. So the drillers, the proverbial driller is the canary in the coal mine, right? Because we speak for the largesse of the exploration budgets. And I haven't spoken to a driller out there that has got a spare rig. You know, the industry's going crazy. There's a big story out there, and like we just seem to be, investors seem to be missing that. The drillers, well, Geodrill specifically, still continues to trade at book value and 3 times EBITDA.
Yeah.
And you could say that our share price has improved in the last 2 years. It has. It has. Evidently, it has. It's improved by 50%. But so too is our financial and our operational performance. In fact, we've lagged.
Yeah, your EBITDA is up, and also the cash balance on your balance sheet is up. And for, again, to remind people that your financials are all in US dollars, but your stock is traded in Canadian dollars. So probably people forget that translation effect there, which minimizes it, whatever, 30% or so. But I want to move on.
If I had my time all over again, I would have just done our accounts in Canadian. We get a lot of confusion about that, but that's to the benefit of the careful investor, the careful reader that would pick up on something like that, which you evidently have.
Yeah. I want to talk about your geographies. You're obviously West Africa. That's where you started and grew, and now then you moved to Egypt, and now you're in South America, in Chile and in Peru. In West Africa, huge gold mining region. You're focused right now on Ghana, Cote d'Ivoire, and Mali. 2 of your other regions, Zambia and Burkina Faso, not so much going on there right now. Just quickly, like you've talked about the general state of the market, but lots of drilling going on in West Africa.
Lots going on in West Africa. Yes, we took a strategic decision to remove our rigs from Zambia some time ago. Just because that market wasn't performing for us, didn't meet our criteria. There may be more of those decisions coming. But you know, for the most part, we're bullish West Africa. We're bullish gold. If you're in West Africa, you're going to be drilling for gold. It was called the Gold Coast for a reason. There's lots of gold here. A lot of people overlook this fact. Where is all the gold coming from in the world? Everyone thinks China, Russia, Australia. If you picked any one of those 3 names, you'd be just about right, because they move it around a little bit between them. The average production from each of those countries comes in at about 320 metric ton a year. If we look at what's going on in West Africa, 450 metric ton. So the majority of the world, on a geographical footprint basis, you know, you can fit West Africa, the key producing nations of West Africa, into China twice. So on a geographical footprint basis, it's a much overlooked fact that 50% more gold is coming from West Africa than it's coming from China. But, you know, we can't just rest on our laurels in West Africa. We have had a push for the longest time to get assets out and into other countries and drilling for other commodities, frankly, other than just gold. You know, as I said, if you're in a, you know, it's a very gold-centric market, the West African market. So in looking further afield and introducing diversification of commodities and countries. We looked at South America. So we made our foray into South America a few years ago in Peru, just in time for some political problems to sort of turn up. And that inadvertently sort of worked out well for us because we had an inquiry from one of our West African countries, customers, funnily enough, who was operating down in Chile. And we moved some of our assets down there, and that customer made a discovery, and it's turned into a very interesting story for them and for us because it's increased the requirement for drills down there for us. And also we're getting inquiries around, their neighbours who are basically also interested in using our service. So we're very bullish Chile at the moment, and pleased to report that things seem to be improving in Peru. So we're actually receiving a number of inquiries from there. So we like South America. We like it because it's on the same time zone as North America, so our investors like it. We like it because it gives us diversification in commodities. We're drilling for copper. We're drilling for EV metals, critical metals. We also really like Egypt. That's a new market for us. We've been there for a couple of years, and in the last financial year, it's already spoken for 10% of our total group revenue. So Egypt's going very well for us, and we've just picked up a new contract just now, and so we'll be starting that contract this week. So a new customer, and this has been the history of Geodrill. is just get in with a successful junior and then grow with them, and I'm sure that customer. You can't talk too much about our customers, but I'm sure you'll come back in 5 years' time and they'll be in mind there.
All right. Throughout the year, we touched on this before, but you got the seasonality where Q1 is pretty good, Q2 is your best quarter, Q3 typically is the softest quarter as the rainy season in West Africa, and then Q4 picks up as well. Last year was it was an excellent Q3 that the rainy season was pushed off a bit. And with you're expanding into other geographies, they're still relatively small, but I guess would that smooth out your seasonality? And any thoughts on sort of seasonality and overall growth for the coming year?
Sure. I think personally, I think the seasonality is going to flatten out. I think between Q2 is always our strongest quarter. I think we're looking more like these days we're going to be looking at the revenues will be flatter across the quarters. And as you see, we just put a very solid Q1. Things don't go up in a straight line. I'm expecting our Q2 this year could be flat. It could even be softer. Q3 is looking, based on our order book at this point in time, is looking good. And our Q4 is a bit far out, but it's also looking solid. I think all in all, what we're looking at here is managed growth and the thematic of recurring revenues, which has driven this company since its inception. We move in, we drill for a junior, the junior makes a discovery. Why is that so? Well, because we're in West Africa and this place has missed 50 years of modern exploration. So for the most part, most things we've drilled out here, I can't think of too many places where we drilled that we haven't actually gone to, remained at, and in some cases working on projects that we were drilling 25 years ago. But not one rig with one contract for one junior. These companies have gone through a history of owners, and in some of these cases, these are now owned by tier one miners. We've got all the big guys out here, Barrick here, Kinross here, Asante, Endeavour, BHP, Rio, and they're all here. So, if you're not in West Africa, you're really missing you're missing a piece of the pie. Now, where we've been very successful, I believe, is getting to these jobs, keeping the customer satisfied. It's a song, it's a Simon Garfunkel song, Keep the Customer Satisfied. You should look it up. But no, we do a lot. We're very customer-centric customers. So it's a fact that actually in 25 years, we've never lost a customer. Lost bids, for sure, lost tenders, but we've never been not invited to tender on a job. We've always maintained those relationships. And so if you keep the customer satisfied, these guys, they have a serial requirement to drill. They can't develop their mines without drilling. And once they get drilling, they can't stop drilling. They need to continue drilling because as they deplete, they have to drill out the next year's reserves. As you take a year's production off your balance sheet, that production from gold off your balance sheet, if you do that for 5, 6, 7 years, then you're going to be standing at the podium saying we're shutting down the mine. So it doesn't work that way. Most mines drill what they need to mine in the first 5, 6, 7 years, and then they get into business, they pay down some of their capital, and then they put money back into exploration, which generates more drilling and which generates more. From those recurring revenues from us, we make the cash we make available to buy new rigs.
So Dave, on the outlook for the coming year, it seems like a pretty strong year. You generate a lot of free cash flow. You pay a dividend, which is not typical for a small cap growing company. How much of a dividend are you paying right now, and should investors expect that to continue growing?
Yeah, so 3 years ago, 2021, we became the first of the Canadian listed drillers to start paying dividends. We began with a 1 cent semi-annual, so 2 cents a year. We immediately took that to 3 cent semi-annual last year, 2022, so 6 cents. And this current year that we're in, we've announced that it will be a 4 cent semi-annual. So we've paid the first 4 cents, and the second 4 cents will be paid in the back half of the year. The intention here is to try and aim for like a 2.5% yield. It's a moving target because the share price is moving as well. And so, we're mindful that people can invest their money and get, bonds or whatever, better interest rates at the bank. But really what we are at the heart of it, we're a growth company. The best, we introduced the dividends because some of our shareholders, our loyal shareholders that have been with us for many years, wanted us to, and we had cash on the balance sheet. But the best use of cash for us is to buy rigs. As I was saying before, if we invest in a rig, it just immediately adds $2.5 million a year to our revenue line, of which we generate, high 20s to 30% GP margin. So it spits out a lot of cash. Yeah. And then this is how we fund the growth of the fleet. This is how we have grown since inception. 1 rig and 1 contract 25 years ago. This has been a 100% organic growth story. There hasn't been too many companies. I don't think there's any examples out there of drilling companies that have done that. And so we're completely self-funding from the cash generated from the operation. So we're not really in any situation where we have to borrow money from the bank for our growth or do dilutive, fundraising. Yeah. All right. So looks like you got a strong year. The market's on your back, at least in terms of the capital markets are a little interesting, but the economic markets are fueling a demand for the drilling here. So it looks like you're in a setup well for hopefully another solid year of growth. Before we wrap it up, any final comments, Dave? No, I think we've covered it pretty well. It's we're just busy. We're drilling holes. We're in an interesting cycle. We're in an interesting place at the moment. We're just going to continue to execute. We're going to continue to keep those investors that like dividends satisfied. But we're just going to continue to just keep on keeping on. Just keep going with the Geodrill story. We drill holes. Holes are us. All right. Dave, thanks a lot. Always fun chatting with you. Congrats on another solid quarter, and hopefully we'll talk to you again soon. Cheers.